Price of gold and silver did not crash today. I'm sure some of you, after watching my live stream yesterday, where I forecast we might see a sharp decline in the price of the precious metals, are going to tell me, told you so. But right now, the price of silver up over 3%, gold in the green. I want to talk about this market reaction in light of these jobs numbers that we got today because I find it to be very intriguing to say the least. So, first of all, let's take a look at the markets, where they're at right now, and what is going on because it's not exactly what I expected. And it's a little bit of a different dynamic than we have seen in recent times. And I'm wondering if maybe this means that, the dynamic has changed. But we'll examine all of that in today's video. So, first of all, we got the jobs numbers today from the BLS, and they came in much, much hotter than anticipated. So, total non-farm payroll came in today, 336,000 jobs added in September. And not only that, but they have bucked the trend of revising down the previous month's jobs numbers. In fact, the past 2 months' numbers have now been revised upward. I see some folks in the chat saying hello there. Hello to all of you. Good morning. Do me a favor. Well, it's not really morning where I'm at, but do me a favor and smash that like button if you're just tuning in. Let's get some thumbs up on this video and help get some of this information out there. So we got the non-farm payroll numbers much hotter than expected. I think the consensus estimate was about 170,000, so much, much higher than what was anticipated. And initially, now I had called yesterday, I said that if we get a hot number, we're going to see a sell-off in the price of silver. That was what I was expecting. And I do just want to point out that initially, that was actually the reaction here. This is the headline from Kitco. Red hot U.S. labor market drives gold prices to fresh 7th-month lows as U.S. economy creates 336,000 jobs in September. And you notice this headline came out at 8:35 a.m. The non-farm payroll numbers get released at 8:30. And I want to look at the chart of gold to kind of show you what the initial reaction was here. Now, you can see it in silver, too. That's around 8:30 right there. Here's a chart from SD Bullion, today's video sponsor, by the way. You can check them out with the link down in the description. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. So we saw the price of silver dropping when those numbers came out. But I mean, obviously, it has recovered significantly since then. And you can see it even more on the gold chart. As that headline from Kitco indicated, gold actually hit a significant low, a 7-month low when the numbers came out, spiked right down, just as one might anticipate. Now, let's talk about why I was anticipating that. Well, that's been the dynamic, right? The good news is bad news kind of dynamic that we get here as everything hangs on what the Fed is going to do next. So on Wednesday, for example, we got the ADP numbers, which were very weak. The 89,000 jobs, that was well below their expectations. And what did we see? We saw a market rally because the idea is that if the economy's weak, the Fed might hold off on their rate hikes. We might not get higher for longer. But the flip side of that is that when you get a hot jobs print, you would anticipate that you would get the opposite. You would get a market sell-off because that, in investors' minds, would give the Fed more room to cut rates moving forward. And we've been going through this debt sell-off, a significant debt sell-off, which I want to talk about more in this video. After we get over the kind of market reaction to today's numbers, I want to delve into how bad this sell-off has actually been because it's worse than they're telling you. I mean, it's quite bad, actually. Today, we actually saw the 10-year yield spike up, just like gold and silver spiked down. We saw the debt sell-off continue. And I think at the highs, the 10-year yield spiked up to 4.88%. So that is a very high number indeed. The last time we were this high was back in 2007, right before the Great Recession. But then look what happened. The yield started to come down, just like the price of gold and silver started to move up. So my question for you is, who is buying this debt? I mean, who got into the market today, saw the hot jobs numbers, and thought, well, this would be a great time now that the yield on 10-year debt is spiking up to get into this market and buy the debt? I mean, who is doing it? If you have some thoughts, put them in the chat. Now, I have some thoughts on that as well, but it is just speculation at this point. I mean, I think that it very well could be some action by the plunge protection team, the Federal Reserve, because they probably thought the same thing. If we get a hot number here, we're going to see a big sell-off in the markets. And that is, again, initially what was happening. We had all the major market indexes, as you can see up top there, were in the red when these numbers were released. But then someone got into the market and started buying up stocks and buying up U.S. Treasuries. Now, there's a huge amount of U.S. Treasuries out there. You got to keep that in mind. We have seen a just absolutely enormous expansion of the debt. Even just in the past couple of weeks, the pace has really accelerated. Look at the debt clock now, 33.479 trillion. It was, I think, 2 weeks ago that we hit 33 trillion. So what are we doing? $1 trillion a month now? I mean, we're certainly going to hit $34 trillion in the national debt before the end of the year. But who's buying all of it? That's what I want to know. I mean, you would anticipate that with the debt sell-off that we've been having, a fairly hawkish Federal Reserve telling us that rates will be higher for longer, you would anticipate that the rates would continue to spike up. But that's exactly the opposite of what we are seeing today. Now, despite the fact that the price of gold and silver has risen today, it didn't sell off the way that I was anticipating it might not. Yesterday, I did pull the trigger, by the way, on some more half dollars, the ones that they've got on sale over at SD Bullion. And you might ask yourself, well, why did this guy buy junk silver, buy more silver, if he anticipated the price might sell off the next day? And the answer to that is, none of us can really time this market. I buy silver on the way up. I buy silver on the way down. I mean, I'm glad I pulled the trigger on some of it yesterday because I think I paid about $173 for the rolls of half dollars that I picked up. Now they're up to 179. I acknowledge that it's very difficult to forecast these markets day to day. Although, I'll also say it's only about, 1:30 Eastern time right now. We've got another 2.5 hours before these markets wrap up. We're going to have to see what happens. But ultimately, I feel that the price of the precious metals will have to go higher. We still are not in safe territory, though, yet, if you ask me. I mean, we could still see a significant sell-off event. In fact, the hot jobs number only kind of confirms that. And, if you want more evidence that the debt sell-off isn't done yet, just look at the warning that we got from Janet Yellen recently. I don't have the story pulled up, but she came out and she told us, rates are not necessarily going to be higher for longer. And, Janet Yellen is a fantastic contrarian indicator, if you ask me. So when she comes out trying to assuage markets like that, leads me to believe that rates are probably going to continue to move higher, perhaps even faster than we had originally believed. Now, I want to talk about the risks and the damage that has been done by this bond sell-off and why I believe we still are potentially on the verge of a major sell-off across assets. First of all, you got to understand how these bond rates work. When yields on treasuries move up, and they're moving up at quite a pace, even today, the yield is still up. It's just not as up as it had been. It's come down a little bit. Someone's getting into the market and buying this debt. Again, if you have some thoughts on who that might be, put it in the chat. But stocks are still tremendously overvalued, despite the fact that we've been witnessing this sell-off. This is the Shiller PE ratio for the S&P 500. And this is like an adjusted, an inflation-adjusted, cyclically adjusted PE ratio. And if you look, there's only 2 times, this is where we're at right here, by the way. There's only 2 times in history that we've been higher than this. That was the dot-com bubble and then the bubble that followed the pandemic stimulus. And we're also still sitting right at the same level, just around 30, that the markets were at on Black Friday in 1929, kicked off the Great Depression, the huge market crash there. So stocks are still tremendously overvalued. And as the yield on these treasury assets continue to spike up, that will put downward pressure on stocks and just about any other asset, including the precious metals to some extent, because those assets now are not as appealing in light of the higher yields that investors can get on these bonds. So that I think is indicative of the fact that we have not seen the pan sell off, which I think is coming just yet. Of course, again, I thought silver was going to sell off today, so take everything I say with a grain of salt. None of it's financial advice, but in fact, put a one in the chat if you think we're in the clear, if we've escaped the potential for a massive sell off. Put a two if you still think there's a lot of risk in these markets, because that's what I think. But I would like to, hear what all of you think about that as well. This is an article from Markets Insider. I really don't think that people can wrap their head around how serious this bond sell-off has been. This is the headline from Markets Insider. The collapse in Treasury bonds now ranks among the worst market crashes in history. I'm going to read a little bit of this to you. Since March 2020, Treasury bonds with maturities 10-year or more have plummeted 46%. That's just under the losses seen in the stock market when the dot-com bubble burst. The bond rout is worse than the one seen in 1980 when the 10-year yield neared 16%. And it's even worse for 30-year treasuries. Those have lost over 50%. It's actually, the 30-year bond has plunged 53% over that same time frame. Those are supposed to be the safe haven asset, right? Paper U.S. Treasuries, they're supposed to be the most liquid, the most safe asset around. Well, tell that to folks who have lost 53% on their long-term bond portfolios. Tell that to the banks who are sitting on hundreds of billions or trillions of dollars in losses. Yeah, Rolf Steiner says USA has a AAA rated risk-free treasury bonds. Right, yeah, no risk at all, folks. Unless, of course, the bond yield spikes up. We've got 3 years in a row now that the 10-year yield has been spiking up. That is the first time. Now, I read this somewhere. I didn't actually look at the charts to confirm it, but I read that that's the first time that we've had 3 years of increases, consecutive years, in the 10-year yield since 1787. So, it's not often that you get a bond market crisis that's the worst one that you've had, like, since the founding of the country, right? Yeah, Savage Stacker says way over leveraged. That's exactly right. A lot of these banks, they bought these low yielding bonds with leverage. So not only has the value of the underlying asset gone down 46% for a 10-year treasury, but imagine if you bought those with leverage, and a lot of them did that when the yield was so low. They went in and bought with leverage because the yields were so low. They thought, well, I need to generate yield, so I need to buy more of these than I have cash on hand. So they borrowed money. And that, of course, amplifies their losses. It gives you an idea of why the banking system in this country is on the verge of collapse. So, again, I just want to know who is buying all this debt. Why aren't we seeing the debt sell-off continue? Well, again, the vagaries of the day-to-day market action are up for debate. I mean, who knows what's driving this rally? Perhaps investors are thinking that Janet Yellen's right and that higher for longer isn't necessarily the case. The Fed has been floating out many of its presidents, many of its figureheads trying to tell us that everything's going to be okay with these markets. They're kind of in damage control mode. But I don't know. I think that, Monday could be a very interesting day. I'm hesitant to make another forecast for a specific day after saying that, silver might sell off today. Although, again, trading session's not over. Yeah, John Bethia, he says, Rolf, I thought the USA was rated at AA+. Yeah, some of the ratings agencies have downgraded the U.S. national debt by like one notch. They have brought it down. I think it depends on the rating agency you're looking at. But, this debt right here should not get a AA+. It shouldn't get a B+. To me, this is basically a junk bond rating, especially in light of the unfunded liabilities. I mean, $194 trillion now in U.S. unfunded liabilities. That's the Medicare, Social Security, retirement benefits, all that stuff that the government's on the hook for. So that's pretty much a guarantee that the debt numbers are going to continue to move up. But the pace that they're moving up at right now is essentially an unsustainable rate. I don't see how it can continue to move up at this pace. I mean, if it does, what are we going to hit next year? 34, 35, 38, maybe we'll hit $40 trillion by the end of 2024. That's if this pace of borrowing continues, and I don't think that that's necessarily possible, but if it does, I mean, interest rates are going to have to soar. Interest rates will have to soar, unless, of course, the Federal Reserve comes into these markets and begins intervening. Again, that's just kind of speculation on my part that perhaps this rally that we've seen in the bond market today, or not, it's not even a rally. It's just that it hasn't sold off the way one might expect. Like when we saw the jobs numbers released here. Of course, there's also the possibility that investors are just coming to the realization that the jobs numbers coming out of BLS and all these official government numbers are completely cooked. Put a one in the chat if you think we really added 336,000 jobs. Put a two if you think there's a potential that those numbers might not be entirely accurate. I'd be curious to see what you have to say. I mean, I think that the government jobs numbers at this point are highly suspect. There's an election coming up next year. I think that, I'm sure we'll see Biden come out and claim a victory lap about these jobs numbers, but maybe they're not even going to bother revising fake numbers down anymore. That's why we just added, or why they revised up the past couple months. Maybe they're just done. Maybe it just seems like they're just going to tell you everything is fine at 100%, make up a number and, throw a dart at a dartboard. And that's how many jobs we added. Because think about it. Why would ADP have such a weak number and then the government numbers just blow out all expectations? It seems awfully suspicious to me. Just like it seems suspicious that we see markets rallying on this news. I don't know. I mean, what are we going to see next? It really defies logic to see why we would see markets surging on this news. It's a complete refutation of the dynamic that we've been witnessing. So I would watch out for Monday personally. Keep some powder dry. Of course, like I said, I buy precious metals in this environment, whether they go up, down, or sideways. I'm not too worried about the daily price moves, except if I see them move down, I'll probably buy more. But, one thing I will say is that as much as I thought there was the potential for a drop in the price of silver today, I didn't go out there and short the silver market because I'm not nearly confident enough in my ability to time things as all that. And so, I see a lot of people when I make a forecast telling me, oh no, silver's going to do this or gold's going to do this. And again, I know it's all just speculation, but the way that you can tell if somebody is really sure about a forecast is that they're putting their money into it. And I am buying precious metals. I'm not shorting any of these markets. I'm not trying to time them, but I am continuing to add to my stack whether the price goes up or down. If it goes down, I buy more. That's typically my approach because ultimately, when you see the debt soaring at a level like this, and Markets Insider is telling us that this is the worst bond rout on record, basically, one of the worst bond sell-offs that we've ever seen. Well, the end game is baked into the cake at this point, I think, folks. When something breaks, the Federal Reserve is very likely to intervene in these markets. I think they're going to have to. I think it's going to happen soon, too. Again, this is just a forecast of mine. So, markets can behave irrationally a lot longer than you can remain liquid. That's kind of the old saying. And I just want to take a break real quick. We're at 250 people in the chat. That is awesome. I just appreciate everybody tuning in to this video. Please do me a favor and smash that like button. We're at 73 likes right now. We could hit 100 before the end of the live stream. I've been very pleased with everybody smashing that like button. I can't thank all of you enough for the support and also the kind comments. And, if you want to razz me a little bit when I get a forecast wrong, I completely understand that as well. But again, timing these markets, not something that I think anybody can really do too effectively. Of course, if you could, you'd be a billionaire, right? Because if you think markets are going to crash, you just short everything with a very short-term option or something like that with a huge amount of leverage. You make a ton of money. So I think that you can kind of judge people's forecast by where they're putting their money where their mouth is, and I'm doing that with precious metals. I mean, I'm continuing to stack. Matthew Crustlife says, I just got 100 kilos of gold. Well done, sir. That's quite a purchase. You're behaving like a central bank. Remember, central banks continuing to stack gold at a record pace. They know where this is all headed, and I'm taking a page out of their books. But yeah, we got to keep an eye on these markets. It'll be very interesting to see how things close. It wouldn't shock me if we see a sell-off before the end of the day. I'm just saying, or possibly on Monday, because it just doesn't make a lot of sense. And I can't imagine that when folks saw this news, they just thought, hey, let's go out and buy the debt. I mean, was anybody out there, anybody in the chat going out and buying U.S. Treasuries when they saw that news today? I sure didn't. I don't know. I think that U.S. Treasuries still represent a tremendous downside risk. Not that we're hearing that from the powers that be, but we're in the midst of one of the worst debt sell-offs in history. And this is what happens when the economy becomes addicted to cheap interest rates, low interest rates, and gets massively over leveraged. And then, inflation runs out of control, and the Fed says, well, we got to bring that under control by hiking rates. But at the same time, the federal government is racking up debt at this pace. How high do you think the debt's going to get before the end of the year? I'm going to say I wouldn't even be surprised if we hit 35 trillion. Put a number in the chat if you have a forecast. I think 35 trillion is highly possible. We've already gone about a half a trillion over the past couple of weeks, and there's still plenty of time before January 1st for them to borrow a ton of money. Now, a lot of that money, I'm assuming, is going to the defense industry, weapons for Ukraine, entitlements. One of the problems is that as the economy becomes eviscerated, and we're seeing bankruptcies surge and delinquencies surge, by the way, on just about all forms of debt, small businesses are going bankrupt at a tremendous pace. We're seeing the tax revenue decline. So not only is spending moving up, but revenue is going down because this economy is being eviscerated. So, who's buying the debt today? I don't know. Is it the Fed? I don't know. Not according to them. I mean, do they do things behind the scenes that we don't know about? Probably. I don't think that that's too far of a stretch, but ultimately they're going to be the ones who have to come in and buy all of this debt because I don't think the borrowing and the spending is going to end anytime soon. And the interest on the national debt is also a tremendous problem. According to the debt clock here, we're at about $714 trillion. If you go to the Fed website, the Fred website, they tell us that in Q2 it was, I think, annualized for a rate of north of 900 billion. But very soon, the interest on the national debt is going to surpass the defense spending, which right now, again, the debt clock number sometimes is a little suspect. It says 795. I think the latest defense bill was north of 800 billion. But very soon, the interest on the national debt will surpass all of these other expenses. One of the things we can do on the debt clock is this cool feature is we can do the time machine and we can go to the 2027 kind of on the same pace that we're on right now. And you'll notice that the interest on the national debt, let me get that on the screen for you there. The interest on the national debt, as the debt clock forecasts, nearly $3 trillion by this same day in 2027, will have exceeded defense, Social Security, and Medicare, the main expenses, the biggest expenses. Why try to scare people? Sugar Shane says. I'm not trying to scare anybody. I don't think it's a good idea to be scared. There's no reason to be scared unless you're, holding just a bunch of paper. Listen, during economic crisis is huge opportunity. It was during the Great Depression, I think there were more millionaires created than at any other time in U.S. history. But look, don't bury your head in the sand and act like everything's fine. This isn't me. This is Market Insider just running the numbers. The collapse in Treasury bonds now ranks among the worst market crashes in history. And it's true. That's just math. It's not like a controversial point of view. When 10-year treasuries have plummeted 46%, 30-year treasuries have plummeted 53%, you don't want to just act like everything's fine. You don't want to be like Janet Yellen coming out and telling us, oh, everything's going to be okay. There's no guarantee that rates will be higher for longer. Come on. I'm not trying to scare anybody. I'm trying to warn people. I think it's important to know if the economy's about to fall apart that, we get that information out there. The mainstream media is certainly not going to tell you. The president's not going to tell you. He's going to get out a whiteboard and do some AI weird generated presentation about how Bidenomics is saving everything, as if some little infographics can fix the fact that we're $33.5 trillion in debt. But yeah, don't bury your head in the sand either. To people who say, why scare people? I say, why ignore reality? And don't be scared. Just get prepared. There's a lot of things you can be doing right now to get ready. Things actually haven't even fallen apart right now. Things compared to where they're going, folks, things are pretty good right now. Yeah, Victor Millicent says thoughts and prayers for a soft landing. There's not going to be a soft landing. I hate to break it to you. I mean, I think you can already say that we're in the midst of one of the worst bond sell-offs in history. How is that a soft landing? It's not a soft landing for investors who have lost 46% of their money on their bond portfolio. Yeah, people are afraid, Rolf Steiner says. Well, look, I'm not particularly afraid. I mean, here's what you want to do. You want to, now, again, not financial advice. This is what I'm doing. Let me just tell you. I'm getting into hard assets. I'm diversifying. I own some stocks. I have some cash just in case there's a big opportunity to buy some things. I have some stocks in consumer staples and energy, in miners, which, I think are a huge opportunity right now. Again, not financial advice, just telling you how I'm looking at things. You also want to be getting food. You want to be getting security. You want to be, focus on your physical health. That's something I don't talk about a lot on this channel, but, you can have all the gold and silver in the world. And if you have a heart attack or something, it's not going to do you much good, So, look, when things get tough, you're going to want your body to be in whatever kind of condition you can get it into. Focus on your health. Focus on your ability to produce some food. Focus on your ability to make yourself independent of systems of support. If the water shut off tomorrow, how much water do you have? How good would you be? And I mean, like, if the electrical pumps that pump the water and pressurize the system shut off, what would you do, right? Think about this sort of thing. If there was civil unrest near you, what would you do? Do you have a plan in place? Have you considered this stuff? Even just kind of sitting down and pondering these things, let your brain do its thing. Let your creative juices flow. Think about various scenarios. What would you do? What kind of a scenario would really put you in a bad place? What can you do to mitigate those things? That's all I think everybody should do. I don't think you need to be scared, but that doesn't mean you need to ignore reality. You need to be prepared. That is the most important thing we can be doing right now. And I think part of that, from a financial standpoint, is getting into hard assets. The nice thing about gold and silver, one, they can't print them. Two, they're not electronic. There's no counterparty risk with these things. You can't wake up tomorrow and all of a sudden the bank said, well, we failed, so we just bailed in your account. No, because, you take responsibility for this stuff. It's in your own custody. And, does that entail some risks of its own? Sure. Do what you can to mitigate those. A lot of it is just about diversification and risk mitigation. Don't have all your eggs in one basket, and certainly don't buy the line that this is the greatest economy of all time, because it's not. The bottom line is it's just not. And I think that should be readily apparent to anybody who goes out of the grocery store and, anybody who is having to take on a second job because of inflation. Just think about the jobs numbers added here. Do you think these are a bunch of high-paying jobs to the extent that they're even real, the non-farm payroll jobs? Do you think that they're some high-paying tech sector job, or, in the medical field, or, just some reasonable job that pays a living? Or is it a bunch of consumers who are at the end of their rope? They've run out of savings, they've maxed out their credit cards, and now they have to go out and get a second job. Probably not a job that they would like to have just to pay bills. Is this retirees having to go out and be Walmart greeters? Is this moms and dads, middle-class moms and dads whose paycheck doesn't cut it anymore, so now they got to work evenings at the local bar or the local Applebee's? That is what a lot of these numbers are. You break down the numbers, a lot of government jobs added, by the way. The least helpful jobs of all, the ones that were added to government payrolls, those have to be paid with borrowed money. Keep that in mind. And, their contribution to the economy is questionable at best. Anyway, that's it for today, folks. Sure, the price of gold and silver did not collapse, at least not yet today. And, should it collapse, I will just take that as a great thing. It's not like when, the metals fall, I'm complaining about it. I look forward to it as a buying opportunity. Yeah, John Bethia says, I'm 77 and this economy sucks. Worst that I have ever seen. You've got a lot more life experience than me, John Bethia, but it doesn't shock me to hear that this economy is the worst that you've seen. Now, you lived through the inflation of the 1970s. I missed that one, but I'd be interested to hear, anybody out there who is someone who lived through the inflation of the 1970s and 1980s. How does this compare? Do you feel it more now than back then? Because I expect that we do, because the inflation numbers, just like the job numbers, are cooked. They don't represent the actual price inflation that consumers are experiencing. And yeah, there's a lot that we can learn from folks that lived through the 70s and the 80s and periods of inflation in the past here in the US. Anyway, hey, Savage Stacker, thank you so much. I really do truly appreciate that. To all of you who support this channel, whether it be with a super chat like Savage Stacker there. By the way, go check out Savage Stacker's channel. There's a $4.99 plug for you, sir. But yeah, if you like the video, that is the best thing you can do to support this channel. It helps get this information out there. It helps get the video into the algorithm. And again, I just want to say a huge thank you to all of you for tuning in. Thank you all so much. Stay safe out there and happy stacking. Keep an eye on these markets because I think things are about to get very interesting. Anyway, stay safe and happy stacking, everybody. I'll catch you next time. Smart Silver Stacker out.